Good morning, ladies and gentlemen. It's my pleasure and privilege to be here this morning and to have been asked to chair and moderate this august panel of banking and ancillary services experts. My name is Rizwan Desai, and I'm a senior partner of Collins Newman and Company, the Botswana member law firm of ALN.
Africa is a place where you have to get very involved on the ground.
There is a obvious tremendous opportunity in the delivery of financial and especially banking services in Africa.
There are 3 points I would like to emphasize. One is the development of the capital markets to create long-term funding is one. 2 is giving greater access to credit. And 3rd is, of course, the favorite topic, which is financial inclusion.
We must put in place best global corporate governance practices.
And within the broader banking and financial services sector, there are also challenges to the traditional bricks and mortar banking model from new entrants who are technology savvy and have taken effectively the lead in mobile banking. Of course, the challenge to one industry player is an opportunity for another. And the fact that the banking environment in Africa is undergoing vast structural change with a number of trends coming to the fore is simply a fact. So we will this morning, ladies and gentlemen, be covering some of these trends, being broadly and in sequence the particular challenges of running and growing a bank in Africa, the peculiarities of that. We'll hear a little about that from our experts. Financial inclusion of the unbanked and the role of technology and innovative banking products in reaching the masses. We'll touch on that. And last but not least, the role of a strong and effective central bank to provide the governance and regulatory framework for all of these fantastic operations to take place.
Large international banks doing business in Africa have tended to focus on the top end of the client pyramid, whether it's corporations on one hand or individuals on the other. They have tended to want to bank because that's what sort of fits the if you like, the kind of European cookie-cutter approach, the top end of the client pyramid, the large multinationals and the largest local corporate champions, and then the affluent, wealthy and affluent on the retail side. A truly African bank must serve underserved segments. I think that's a huge difference. Now, to do that, that goes back to my first point around requiring being on the ground with a deep, nuanced sense of each market to be able to do that safely.
Taking into consideration these engines of growth, it's very easy to recognize that all these initiatives are fairly capital intensive. You have to expand network, both brick and mortar traditional delivery channels and also virtual. Requires a lot of investment in technology and human capital. And these, alongside amended prudential guidelines, reinforcing and increasing capital adequacy ratios, put a big question mark on the ability of African banks to raise new capital.
The need for infrastructure in Africa is insatiable. One estimate, for the next 10 years, Africa would need about $100 billion a year in terms of financing to support its appetite for infrastructure. And today, only $50 billion is available. Now, it's nice to talk about raising foreign currency for local projects, but a lot of that has to come in local currency. For that to happen, capital markets have to develop. Kenya is one market there you have long-term yields, paper, but many African markets you don't. So there's a role to play in banks working with the regulator, working with customers like pension funds, people who have long-term money, to develop capital markets.
Now, as central bank, we must be a proactive, efficient, and effective regulator because all these mobile network companies have interfaced with the banks. Now, initially, there was resistance from the mobile companies of these, not the mobile companies, but from banks, of the services offered by the mobile operators, but they decided to join them. And therefore, that makes the work of a central banker fairly heavy. But apart from that, in the financial sector, we have many other regulators. Now, central bank plays a collaborative role between all these regulators. And that is why currently we are working on a concurrency regulations so that we don't encourage operators to shop for the regulator that will give them the first node. And that is on course.